Welcome to Safe Simple Sound Podcast. This is episode 21. In today's complex financial landscape, bonds remain a cornerstone of investment portfolios, offering stability, income, and diversification. With the help of AI voices, we will explore the mechanics of bond markets, their relationship with interest rates, and key insights for investors aiming to navigate this essential asset class. Let's dive in.
Imagine if you could predict the financial future with just one simple principle. What if I told you that understanding how bonds move could be your secret weapon in navigating market uncertainty?
Wait, really? Most people think bonds are just boring financial instruments. How can they actually be a secret weapon?
Most investors don't realize that bonds are like a sophisticated financial dance, where interest rates and prices are constantly negotiating with each other, and in that dance lies billions of dollars of potential strategy.
I'd love for us to explore how these dynamics play out in the real world, especially when it comes to Federal Reserve decisions.
Absolutely. The Federal Reserve's monetary policy is one of the most influential forces in the bond market. When the Fed adjusts the federal funds rate, it sets off a chain reaction that impacts both existing bonds and new issues.
Okay, so walk me through this. Let's say the Fed decides to raise interest rates. What happens to bonds?
Great question. In a rising rate environment, or what we call a monetary tightening period, the value of existing fixed-rate bonds typically decreases. That's because newly issued bonds start offering higher yields to keep up with the higher prevailing interest rates.
So it's like the new bonds are saying, hey, I can pay more now. And suddenly the old bonds with their lower rates don't look as attractive anymore.
Exactly, the market has to adjust to maintain competitive returns. On the flip side, when the Fed lowers rates or enters an easing cycle, existing bond prices tend to rise. The higher coupons on those previously issued bonds suddenly become more valuable.
I think I'm starting to see how this dance works. So as an investor, I need to be aware of these shifts and think strategically. If I expect rates to fall, I might want to scoop up some of those higher coupon bonds, right?
You've got it. Of course, it's not always that simple, and there are many other factors to consider. But understanding these core principles gives investors a solid foundation for navigating the market.
This is such an important perspective. I love how we can see the direct link between these high-level Fed decisions and the actual investment choices individuals make.
Definitely. And this knowledge can help investors unlock some key benefits. Bonds can provide stable income streams, help diversify a portfolio, and even offer capital appreciation potential when played strategically.
I have to admit, I used to think bonds were pretty one-dimensional. But it's clear there's a lot more nuance and opportunity here than meets the eye.
I think that's a light bulb moment for a lot of folks. Bonds may not be the flashiest investment, but understanding their mechanics can be a real game changer.
Well said. The bond market is a complex and constantly shifting landscape, but armed with these fundamental principles, investors can make more informed decisions and effectively manage risk while pursuing their financial goals.
Beautifully put. And that's really the heart of it, empowering people to make smarter choices with their hard-earned money. Thanks for breaking this down for us today.
It's my pleasure. The world of investing can feel daunting, but it's conversations like these that help demystify it and put the power back in the hands of individuals.
Agreed. I feel like I have a much clearer understanding of how bonds work and how I can use them strategically. It's exciting to realize there's always more to learn and new angles to consider.
Great. So we've covered some key dynamics of how interest rates and Fed policy shape the bond market landscape. I'd love to dive a bit deeper into what this means for investors on a practical level. What are some of the key strategic implications to keep in mind?
Absolutely. Understanding these market mechanics can really help investors make more informed decisions. One key consideration is the concept of duration risk. Essentially, the longer a bond's maturity, or the more distant its cash flows, the more sensitive it is to interest rate changes.
Okay, so if I'm expecting rates to rise, I might want to focus on shorter duration bonds to limit my exposure to potential price declines, right?
Precisely. Adjusting your portfolio's average duration is a powerful way to manage interest rate risk. In a rising rate environment, shifting toward shorter-term bonds can provide some insulation. Conversely, if you anticipate rates falling, extending your duration can help you capture greater price appreciation.
That's a great point about being proactive in aligning your bond portfolio with your interest rate outlook. What about the role of different bond types? We've mostly been discussing dynamics in the context of individual bonds, but there's a whole ecosystem of bond mutual funds and ETFs out there.
Definitely. Managed bond funds can offer some distinct advantages, particularly for investors looking for professional oversight, instant diversification, and liquidity. Bond ETFs have really democratized access to this asset class.
So with a bond fund, I'm essentially outsourcing the security selection and trading decisions to a portfolio manager.
In essence, yes. Bond funds allow you to tap into the expertise of seasoned professionals who are constantly monitoring the market and adjusting holdings as conditions evolve. They can be a powerful tool for investors who want bond exposure but may not have the time or inclination to manage individual securities.
That's a great insight. It really speaks to the importance of understanding your own investment goals and constraints. For some, the granular control of individual bonds might be appealing, while for others, the simplicity and broad diversification of bond funds may be the better fit.
It sounds like there's no one-size-fits-all approach. It's about understanding these different options and aligning them with your specific objectives.
Exactly. Whether you're prioritizing income generation, capital preservation, or portfolio diversification, there's likely a bond strategy that can help you achieve those goals. The key is to understand the inherent trade-offs and to make informed decisions based on your individual circumstances.
This has been such an enlightening discussion. I think one of the key takeaways is that while the bond market can seem complex and intimidating at first glance, understanding these fundamental principles can really empower investors to make smarter, more strategic choices.
Absolutely. Bonds play such a vital role in a well-rounded investment strategy. By demystifying these concepts and highlighting the practical implications, we can help investors harness the full potential of this asset class.
Those are all great points about the fundamental role bonds play in a diversified investment strategy. I think it's also worth diving a bit deeper into some of the specific risk management considerations for bond investors. What are some key factors to keep in mind?
Absolutely. One crucial concept is the idea of credit risk. Essentially, the possibility that a bond issuer may default on their payment obligations. This is where the distinction between investment-grade and high-yield bonds comes into play.
Right, investment-grade bonds are issued by entities with strong credit ratings, indicating a lower risk of default. High-yield or junk bonds, on the other hand, offer higher potential returns, but also carry greater default risk.
Precisely. Investors need to carefully consider their risk tolerance and investment objectives when deciding how much, if any, exposure to take on in the high-yield space. Diversification becomes especially important here.
That's a great point. It's not just about the individual bonds you hold, but how they interact within the context of your broader portfolio. What about the role of bond laddering as a risk management tool?
Bond laddering is a powerful strategy that involves building a portfolio of bonds with staggered maturities. For example, an investor might divide their bond allocation equally among securities maturing in 1, 3, 5, 7, and 10 years.
I see. So as each rung of the ladder matures, you can reinvest the proceeds into a new longer-term bond. Over time, you have regular opportunities to adjust to changing market conditions.
Exactly. Laddering helps manage both interest rate and liquidity risk. You're not locked into a single rate environment, and you have bonds maturing at regular intervals to provide cash flow or reinvestment opportunities.
This really underscores the importance of approaching bond investing with a strategic, long-term mindset. It's not just about chasing the highest yields in the moment, but constructing a resilient portfolio that can weather different market cycles.
It sounds like the key is to strike a balance between generating income, preserving capital, and allowing for flexibility as conditions evolve.
Absolutely. And of course, individual investors' specific approaches will vary based on factors like their age, financial goals, and appetite for risk. The beauty of the bond market is that there are strategies and securities available to meet a wide range of investor profiles.
This has been such an informative discussion on the nuances of bond investing and risk management. What would you say are the key takeaways for our listeners?
I think the main points are to understand the fundamental drivers of bond performance, to take a strategic approach to portfolio construction, and to always keep your individual financial objectives at the forefront of your decision-making process. Bonds can play a vital role in helping investors navigate shifting market conditions and working toward their long-term goals.
Agreed. It's clear that while the bond market can seem complex, understanding these core principles and strategies can really empower investors to make more informed, confident choices.
Fantastic insights. Let's dive a bit deeper into the mechanics of how bonds work and the factors that drive their performance.
To start, it's helpful to think of a bond as a contractual lending relationship between two parties: the bondholder, who acts as the creditor, and the issuer, who serves as the debtor. When an investor purchases a bond, they are effectively lending money to the issuing entity, which could be a government, municipality, or corporation.
So, in exchange for providing this capital, the bondholder receives regular interest payments and the return of their principal investment when the bond matures, correct?
Yes, the interest payments are based on the bond's coupon rate, which is set when the bond is first issued. Most bonds start with a par value or face value of $1,000. This standardization serves as the foundation for calculating returns and interest payments.
That's a great point about standardization. How does that work in practice?
Let's say a bond has a 5% coupon rate and a $1,000 face value. This bond will pay $50 in annual interest, typically split into two semi-annual payments of $25 each. This predictable income stream is one of the key benefits of bond investing.
I see. So the par value provides a consistent baseline for comparing different bond offerings and understanding their potential returns.
That's right. Now, it's important to understand that the market value of a bond can fluctuate over time, even though the par value remains constant. This is where the relationship between interest rates and bond prices comes into play.
Let's break that down a bit. What happens to bond prices when interest rates change?
The key thing to remember is that bond prices and interest rates have an inverse relationship. When interest rates rise, the market value of existing bonds tends to fall. Conversely, when rates decline, bond prices typically increase.
Why does this inverse relationship exist? It seems counterintuitive at first glance.
Think of it like a seesaw. When interest rates go up, newly issued bonds start offering higher coupon rates to keep pace with the market. This makes the older, lower coupon bonds less attractive by comparison, so their prices must decline to compensate investors for the lower relative returns.
That's a helpful visual. So if I own a bond with a 3% coupon and market rates rise to 4%, my bond becomes less appealing to potential buyers.
Exactly. The price of your bond would likely decline to make up for its lower coupon rate. On the flip side, if you bought a bond with a 5% coupon and market rates later fell to 3%, your bond would trade at a premium since its higher coupon is now more desirable.
This seems like a key concept for bond investors to grasp. How can we apply this knowledge in a practical sense?
A recent real-world example is the Federal Reserve's decision to raise interest rates several times over the past year to combat inflation. As the Fed funds rate climbed, we saw a corresponding decline in the prices of many previously issued bonds.
That's a great point. Investors who were holding longer-term, fixed-rate bonds likely saw the market value of those holdings decline as rates rose. This underscores the importance of considering your investment time horizon and risk tolerance when building a bond portfolio.
So, if you expect rates to rise in the future, it might make sense to focus on shorter-term bonds or those with floating rate coupons to minimize interest rate risk.
Absolutely. This is where a strategy like bond laddering can be useful, as it allows you to spread your investments across a range of maturities to manage interest rate risk over time. As each rung of the ladder matures, you can reinvest the proceeds into new bonds at the prevailing market rates.
These are all excellent insights. I think this really highlights how understanding the mechanics of bond pricing and interest rate dynamics can empower investors to make more informed decisions.
Definitely. I want to emphasize that while the bond market can seem complex, grasping these fundamental concepts is the key to navigating it effectively. By understanding how interest rates impact bond prices and by taking a strategic, diversified approach to building a bond portfolio, investors can unlock the potential benefits of this essential asset class.
Let's dive a bit deeper into the different types of bond yields and what they tell us.
Absolutely. While we often speak about bond yields in a general sense, there are actually several key yield measures that investors should understand, each providing a unique lens on a bond's return potential.
I've heard terms like coupon yield and yield to maturity before, but I've never been entirely clear on how they differ. Could you break that down for us?
Of course, let's start with the most basic measure, which is the coupon yield. This is simply the annual interest rate that's set when the bond is first issued. So, if a bond has a face value of $1,000 and a 5% coupon rate, it will pay $50 in interest each year.
And that coupon rate remains fixed throughout the bond's lifetime, correct?
That's right, the coupon rate doesn't change. However, the actual return an investor receives can vary depending on the price they pay for the bond. This is where the concept of current yield comes into play.
How does current yield differ from the coupon rate?
Current yield takes the bond's market price into account. It's calculated by dividing the annual coupon payment by the bond's current price. So if that same 5% coupon bond is trading at $900, the current yield would be 5.56%.
So the current yield gives investors a more accurate picture of their immediate return based on actual market conditions.
Precisely. It's a way to compare the income potential of bonds with different coupon rates and market prices on a standardized basis.
That makes sense. Now, what about yield to maturity? I've heard that's the most comprehensive measure.
Yield to maturity, or YTM, is indeed the most holistic yield calculation. It accounts for all of the bond's future coupon payments, the time remaining until maturity, and the eventual return of the bond's face value, in addition to the current market price.
So it essentially tells you the total return you can expect if you buy the bond today and hold it until it matures.
Exactly. By considering all of these factors, YTM gives investors the clearest picture of a bond's true return potential over its remaining lifetime.
I can see how these different yield measures provide valuable insights for investors. But how do they tie back to our earlier discussion about interest rates and bond prices?
Great question. As we covered last time, changes in prevailing interest rates can have a significant impact on bond prices. When rates rise, new bonds are issued with higher coupons, making existing bonds less attractive by comparison. This puts downward pressure on the prices of previously issued bonds.
And this is where the different yield measures come into play, right? As bond prices fluctuate, so do the various yields.
Absolutely. If bond prices fall, the current yield and YTM will rise, since investors are now getting a higher return relative to the lower purchase price. The opposite is true when bond prices rise, current yields and YTM will decline.
So investors need to pay attention not just to the overall direction of interest rates, but also to how those changes are impacting the specific yields of bonds they own or are considering purchasing.
That's exactly right. By understanding the dynamics between interest rates, bond prices, and yields, investors can make more informed decisions about how to structure their bond portfolios and navigate changing market conditions.
This has been incredibly enlightening. As we wrap up, what would you say are the key takeaways for our listeners?
I think the main points are 1. Coupon yield, current yield, and yield to maturity each provide different but complementary perspectives on a bond's return potential. 2. Changes in market interest rates can significantly impact bond prices and yields. 3. Understanding these dynamics is crucial for making informed investment decisions.
Fantastic. Thank you so much for breaking this down for us today.
Yes, I feel much better equipped to analyze bond opportunities and think strategically about my fixed income investments.
We're so glad to hear that. And thank you to our listeners for joining us on this journey. We'll be back next time with an in-depth look at the different sectors of the bond market, from treasuries to corporate bonds and beyond. Until then, stay curious and invested.
That's all for this episode. If you found it valuable, don't forget to subscribe to the podcast. You can also join my newsletter at savesimplesound.com for more insights. Until next time, take care and bye for now.